Hi, this is Andy Pratt, a partner and director of investment strategy at Burney Wealth Management. And I'm joined today by Bijal Patel, also a partner and senior wealth advisor on the team. This is Byte Size Retirement, where we take common retirement planning topics and break them down into bite-sized 5-minute pieces. These videos are not meant to be investment or tax advice, but hopefully help remove some mystery and provide a solid foundation to plan off of. Remember, while we might be taking 5 minutes to explain these topics, don't take 5 minutes to make any of these decisions. So today we're going to talk about the dangers of investing rules of thumb. Bijal, can you give us some examples of these?
Sure. I get these questions all the time in regards to, should I be doing this because I've heard the statistic out there? One of the ones I hear all the time is around, for retirees, how much money can I take out of my account itself? And it's been known as the 4% rule. And they figured they have got a nest egg that's big enough and they could take out 4% of the value of their portfolio as their income in retirement itself. And for retirees, another one that we hear about a lot is around how much income do I actually need in retirement compared to when I was working? And we hear of the 80% rule. So if you can have 80% of your income in retirement, you're going to be okay. And then based off of those two things, people try to work backwards to understand how should they be investing. One of them is just in regards to the stocks to bond allocation within your portfolio. And that's taking the number of 100 and minusing your age to indicate, how much you should have invested in equities themselves. With people living longer these days or actually needing to take on more risk, they've kind of moved that number up to 110. So you might hear many people saying 110 minus your age is a good way to come up with an investment strategy itself. And then when they work backwards to kind of figure out, okay, how are these formulas going to work? They want to make some assumptions around what types of returns can I get? And we hear the 10-5-3 rule. And that's to say the part of your portfolio that you have invested in equities, you can expect a 10% rate of return. For the next part that's invested in bonds, you can expect a 5% rate of return. And then finally, for that last bucket of where you're diversifying your portfolio in cash, you can get 3% rate of return on your cash itself. Now, I think people can make some assumptions today. Is that possible or not? We'll find out. And I think that helps us poke some holes. But Andy, as we talk about these rules of thumbs, can you kind of give us some ideas in regards to why these rules sound like either a terrible idea or what the problem is with them?
Yeah, sure. And I think for a lot of these rules, they can be a good starting point, but they should definitely not be the end point. And there's a couple of reasons for that. One, when we're talking about your investment portfolio, this should be personalized to you. So you've got your own personalized risk tolerance level. You've got your own personalized ability to take risk. And none of these rules of thumb are taking that into an account. So if you're just taking 100 and subtracting your age to come up with your stock to bond mix, is that appropriate for you? Is that too much risk for you? Are you just going to feel like you're leaving return on the table and it's not risky enough? These are things that you have to answer and then get to the right asset allocation from there. And the other thing that is completely absent in these rules of thumb are what are your goals and objectives? So, we hear about the 4% rule, the 80% of pre-retirement income rule, things like that. But, the thing that's going to dictate that withdrawal rate is whatever your goals and objectives are. Maybe you need more, maybe you need less. And that could also impact the choices you make when you build out your portfolio. So, none of these rules are specific to you. But Bijal, you were mentioning it too with the 10-5-3 rule that, any sort of decisions need to be made within the current market environment. So, maybe there was a day where 10-5-3 was reasonable, but I think most people are expecting a lower return environment. And you can just see it with things like cash and bonds, where interest rates are relatively lower, that the expectation can't be that whatever returns happen over the last 30 years are going to be repeated going forward. So the other problem with these rules is you might end up with a portfolio that isn't going to actually help you achieve your goals. It might run out of money. If you're relying on 10% from equities, 5% from bonds, and 3% from cash to get there, you've got a high probability of coming up short. And so that's something that needs to be taken into account as well. So Bijal, let's say that I am an investor who's been relying on these rules of thumb, but, after listening to this, I might be, trying to figure out what my options are. So what should I do?
Yeah, I think as you mentioned earlier, these rules of thumbs are a good starting point. I don't think it's the say end and be all of how you should come up with your strategy itself. So think of it as a starting point, but from that starting point, how do you fine tune exactly what these numbers need to be for you to have a successful retirement itself. One of the things that we do at Burney Wealth Management is we help our clients kind of clearly understand what is their investment strategy by creating a balance sheet for them and also a cash flow analysis. This helps us really fine tune your own number. So I think that's the most important thing, right? It's your number, not a rule of thumb. And that's what we could do to help. So we hope that we found this helpful. If you have any questions, please let us know. And please don't forget to leave a comment below. Thank you.